This is our Forex blog for February 7th, 2012. And like most days, we want to buy the strongest currencies against the weakest and sell the weakest versus the strong. We compare statistically each currency to every other one. We have the dollar and yen on the top, which most people trade against the currencies on the bottom. The top histogram shows the real-time strength or weakness. It's made up of 5 different statistical trend tools. Three of them measure the direction, and 2 of them measure the statistical intensity of the direction. And underneath that we have the daily, weekly, monthly trend. I don't focus on the monthly trend, but I do want the daily and weekly trend to be in the direction of the momentum today. I would prefer that. Sometimes you have a day after a currency might be up or down for 3 or 4 days in a row where it changes direction. Obviously the real-time momentum on the top trumps the longer term trend, but anytime they all line up, it's just a much better odds. And the trends can oftentimes go for 1 to 3 hours, and they give you opportunities of catching, 20 to 50 plus pips. The Australian and the New Zealand are the strongest longer term, and they both had strength today as well. The New Zealand, for the most part, had a lot of strength until 6, whereas the Australian was only strong until about 2, and then it started to have a little bit of strength at 7. So anytime you see a lot of weakness in a currency where all the time frames are down, and I would prefer the yen last night because it has a lot of weakness followed by less strength. You can see the dollar had some strength coming into 2 o'clock, whereas the yen didn't. So the New Zealand yen is a very high probability one to be buying around midnight and thereafter. Here's the chart. You can see the price is above the hourly moving average. Here's the Fibonacci profit targets. I spend about 30 or 40 minutes every night doing Fibonacci analysis for my own trading and devised a way of putting it into our software so my levels show up on your chart. I show the Fibonacci retracements in light gray, and in dark gray we have the Fibonacci profit targets, and this is part of our trading zones, which as the price goes up, the statistical likely lows also rise with the price. So if it comes down later in the day and hits one of these, the better odds it is. But anyway, some of the trades you might have taken today, it was going sideways right here above the previous day's high. You buy this breakout right here, and you would have had a small loss. Having losing trades is part of trading. It pulls back and finds support at the hourly and breaks out. You go long again, and you always want to draw your fib. Sometimes the market hits them, sometimes it doesn't. You can see it hit this fib target from here. This is a previous swing high. You also want to draw your fibs on this, which you can see is the later high of the day. It also lined up with one of my Fibonacci profit targets I did last night. Anyway, so you're in this trade right here at 89, and if you got out here at a trailing stop level, you can see you made 20 pips. So you might have lost 5 or 6 pips, then made 20. And really, that's in a nutshell how you trade. Once price came down and broke underneath the hourly, I wouldn't be buying it again until you can see the statistical weakness kind of subsided here at 8:30, 9:30. At that point, it's a little higher odds. I just hit the plus key to zoom in on the chart. When it goes down with a lot of weakness, comes back up, comes back down, and the weakness is gone. When the daily trend's up, the weekly trend's up, the monthly trend's up. Here's a trade I might have taken, only would have made a few pips, and then it came down again, found support. Anytime it proves to you by hitting a support level and bouncing off of it, it's usually a pretty high odds trade. You get into this trade right here, and you're out somewhere at the first or second fib target. So 03, maybe you would have got out up here at 23. Another 20 pips, figure 3 pips on the next one. That's 23 pips, 5 or 6 pip loss, and then another 15 or 20 pip win. So you could have made 30 to 35 pips in the New Zealand yen today. Let's look at some of the other patterns that showed up later in the day. The euro was very strong all day, and anytime you have a lot of momentum like this followed by very little weakness, visually I like to see an extreme explosion one way in a trend, and it should last for at least about an hour, which it did here. I like to see at least 2 to 5 bars above the 80 level, which we consider extremely strong. And then during the pullback, if you get 20 minutes or 30 minutes of weakness that's 1/2 to 1/3 of what the previous momentum move is, this is a trend that's very likely to continue. Now, I wouldn't bet the farm on it because the weekly trend's down in the euro and so is the monthly. But this is a euro. You're going to be looking to buy the euro Even as early as 3:30, you're looking to get in a trade. You might have had a break even or a loss, and then the strength resumed, which most of the time it does. Coming up to 3:30, you can see the dollar, because of the previous momentum, was extremely weak. 3:30, looking to buy the euro dollar, and you can see this one had a two-wave pullback, and it's usually easier on a range chart. So I'm going to bring up a range chart, which I think, for me, finds a lot better odds trades, and it also uses super tight stops. At 3:30, this one came down and found some support at the previous day's high. I would have probably bought right here. I always have my stop underneath the low, and you can see it starts to go up, has a little bit of momentum, and on these bars right here, starting to show some weakness, and you get stopped out. 5-6 pip loss. Comes down to the previous, or I should say the hourly moving average, and you can see statistically comparing each currency, it's less than 1/2 weakness compared to the previous strength. I like it when it hits the hourly and kind of goes sideways for 3 bars, but in this case it breaks out immediately. You're in this trade somewhere around 30, and you can see if you got out the trailing stop, that's a 47, so you made 17 pips. Previous to that, you can see the price was above the hourly, and it came down and found support at the hourly, and when it busted through the highs here, notice how tight our trailing stop is on the 6 pips per bar chart. This is called the FX Build Your Own Stop, and it allows you to use all of our best statistical trend tools. You can pick the time frames, the weighting of each one, and it basically compiles statistical momentum. And let's say in this case the market's going up, the euro is pretty much going up against every currency, and the dollar's going down, and it's doing so with incredible intensity. When that's the case, we have a wide stop. When the market moves statistically too far, which is above our upper containment bands, above the 1-hour statistical hourly high, above the 4-hour statistical high, we tighten the stop because the market's very likely to reverse, and it oftentimes can catch you an extra 5 to 12 pips on the trade. You can see it caught pretty much all of this move from 57. The price went all the way up to 68. It got all of the pips except 11. So that's one of the reasons why I like using range bars. Now, once the price is underneath the hourly, it's much more likely to go down. You can see this trade right here, you might have went short. It didn't make you that much money, but you didn't lose money on it. And once it came back up and it busted through the hourly again, this is usually a pretty decent place to get long when it comes from below to above the hourly. And most of the time, the Fibonacci profit target is a great place to get out. Notice at 85. If you bought this at 30, it went up about 55 pips. Or you could have just traded it and got out here, and then you also have a nice, beautiful trade here. On a range chart, one trade that I really live and die by, it's probably my bread and butter if I had to name one trade, is finding a strong momentum. And then, because it's a range chart, these are 6 pips per bar. I like to see at least 3 red bars, 3 to 5. And then after the first green one, which is right here, I buy it when it goes 1 pip above the high. So I would have bought on this bar at 31.50 with my stop a pip or 2 underneath the previous day's high. I'm risking 12 pips, and you can see you already had the Fibonacci profit target of the previous move. We have the upper containment band, which most of the time is the end of the move. And I would have just got out of this trade here at about 84. That's a 34 pip win while risking 6 pips, which is what the number of pips per bar is, plus 1 or 2 pips padding. So the key to trading is small losses, big wins. And using a range chart, you always keep your losses small because you can put your stop just a pip or 2 on the other side of that range bar. If you use 5-minute bars, 15-minute bars, 30-minute bars, you're not consistently having the same stop if you put your stop above or below the previous bar's high or low. Because a bar could be 5 pips, 10 pips, 12, or 15. So the nice thing about the range charts is not only does it have a super tight and amazing stop, you got to look at this, how tight this stop is, and it gets you out the perfect place. A lot of our traders are even using these as entries. If they're finding really strong currencies like this, they're waiting for the pullback, they go long right here, they're out right here at 87, they're in this trade at 55. That's a 32 pip win right there as well.